and welcome to Ipsy Dixit, a podcast on legal scholarship. I'm your host, Luce Nguyen, a college student and the co-founder of the Oberlin Policy Research Institute, an undergraduate public policy research organization based at Oberlin College. My guest today is Jay Soled, professor and the director of the Master of Accountancy in Taxation program at Rutgers University. We will discuss his paper, Reimagining the Estate Tax in the Automation Era, in the UC Irvine Law Review. Welcome, Professor Soled.
Thank you.
So let's begin by talking about why did you write this paper and what's the main crux of your argument?
Well, I wrote this paper because over the last 2 decades, the estate tax has really been in a state of decline. And I thought it would be important, particularly as we see automation more and more on the economic forefront, that Congress as a whole has to revisit how it raises revenue for the country, and that one place it may consider starting is with the estate tax. That could be a rich resource to collect the necessary revenue to propel the country forward.
So can you talk a little bit about the history of the estate tax and how it came about?
Well, insofar as the estate tax, its origins date back prior to the turn of the century. And when I say the turn of the century, I mean the 20th century. And there was motivation to begin an income tax, and we saw that vis-a-vis the 16th Amendment to the U.S. Constitution instituted the income tax, and we had the income tax start in 1913. But at the same time, Theodore Roosevelt also thought that there was too much wealth concentration, particularly in the era of the robber barons and with railroads and things like that, that there was a great deal of wealth concentration. And that being the case, Congress was motivated soon after the institution of the income tax in 1913 in 1916 to institute the estate tax, because World War I was on the horizon and the country truly needed another source of revenue. The income tax was, delicately put into place because Congress was fearful of too much opposition. So the income tax only affected a very, very narrow slice of taxpayers residing in the country in 1913. So to get the necessary revenue this country needed to fund World War I, the estate tax began in 1916. And like the income tax, it applied to a very, very small sliver of the U.S. population. But it played a critical role even back in 1916 when it was put into effect about raising sufficient revenue to help propel the income tax. The two taxes functioned together to bring our country away from what in the past the country raised revenue primarily through a tariff system, but that wasn't working out too well. So we shed the tariff system, and in lieu thereof went to an income tax and then to the estate tax.
So can you talk about the modern estate tax and its threat of repeal?
Well, the modern estate tax, so bear in mind that the estate tax has just celebrated its 100th birthday, having been in effect since 1916. And it's certainly, ever since Ronald Reagan back in the 1980s was elected, the estate tax, and as it's known by those who disdain it, the death tax, has been under attack, a strong attack, particularly by the Republicans after Ronald Reagan or during his tenure and thereafter. And over the ensuing years, we've watched rates which used to be as high as 70%, in some cases as high as 77%, the rates dropped precipitously, where right now there is a flat 40% rate, and where the estate tax used to affect a fairly significant minority of people, In other words, sometimes the estate tax was borne by as much as 7% of the U.S. population. It now affects less than 0.1%, and that's not a misstatement on my part. 0.1% of the U.S. population in the year 2019 bears the federal estate tax. And just to put that down in terms of numbers, there's about 3 million decedents in the U.S. per year, and there's less than 3,000 taxable returns. So that gives you an idea of just how small the estate tax or its scope, how much has been reduced in the last 20, 30 years.
And can you talk a little bit about income taxes and their relation to the estate tax?
The two taxes, income is levied, as all of us know, on an annual basis, and the estate tax is a once in a lifetime of someone's accumulated wealth. So the nature of the taxes are different, but there's a bit of a give and a take because this country needs to raise X amount of revenue every year, and it's got to come from somewhere. So Congress doesn't have a large number of choices, at least for the time being. It could always institute, say, a value-added tax or a so-called VAT. But for the time being, it's settled upon largely income taxes, payroll taxes, and the estate tax. So the relationship is there's a give and take where if one tax raises more revenue, that relieves the other tax. But if one tax is now slated to raise less revenue, that puts a greater burden on, in this case, the income tax.
So let's talk about automation and its effects on the tax base.
Right. Well, what I foresee happening in the age of automation is that since the income tax, like the estate tax, was instituted about 100 years ago, when the income tax was first instituted, there was a lot of emphasis on taxing labor. And that happened in the early 1900s, but as a product of Social Security and then Medicare, Congress put additional weight on labor income vis-a-vis payroll taxes. So labor income is probably the greatest source of revenue for the U.S. government. However, and by way of contrast, I should say, capital income is one of the least taxed forms of income because capital income is ordinarily taxed at preferential capital gains rates, and often it's not taxed at all. So bearing that in mind, that in an age of automation where there's a real priority put on capital, and labor income seems to be more of an ancillary importance because there's now, or at least in the foreseeable future, as automation becomes more commonplace and labor income declines, Congress is going to find a waning amount of revenue because it's always tied itself, Congress, the revenue base, to labor income. Well, guess what? As labor declines in an age of automation, we're going to watch revenues drop, and taxing capital, at least as the current system is configured, will not suffice, will not make up the shortfall that is likely as labor revenues decline, or revenue from labor decline.
So what's your proposed solution for this issue?
Well, given the fact that automation is here to stay, and if anything, automation is going to become on steroids, so we can anticipate more and more automation. We're going to see labor income decline, and as labor income declines, revenue declines. So we could try to institute higher capital gains rates, but my fear is if you institute capital gains rates that are too high, that you may exacerbate something called the lock-in effect, where people hold their capital assets, they don't sell their capital assets. Or alternatively, because capital is mobile, that you might see capital being drained from the country. So those are my concerns about just switching gear and instead of taxing labor income, automatically switching and taxing capital income. Instead, if Congress was to put into place a more robust estate tax, we could hope to make up for the revenue shortfall in that fashion.
So what does a reimagined 21st century estate tax look like?
Well, in my perfect world, reimagined 21st century estate tax has several facets or components as spelled out in my paper. The first, there would be a drastic reduction in the lifetime exemption amount, which is currently $11.4 million. In my opinion, if we drastically reduce that, say, to $1 million, that we would have a much greater proportion of the population being subject to estate tax, and it would raise a vast amount of more revenue. So that's one component. The second is that we should increase estate tax rates. Remember, anyone who receives an inheritance, this is a complete windfall. So I have no problem if the estate tax rates were significantly increased. And just to make sure that the integrity of the estate tax remains in place, that the estate tax base should be tightened and should be expanded so that taxpayers can't readily skirt their obligations. And finally, a reimagined estate tax would ensure that the so-called generation-skipping transfer tax, which seeks to impose a tax at once at every generation, the idea would be, under current law, people or taxpayers are setting up what are known as perpetual trusts. And these are trusts where wealth cascades down multiple generations without being subject to estate tax. In my reimagined world, we would make sure, Congress would make sure legislatively, that wealth gets taxed at least once at every generational level.
So let's run by that line by line. First of all, what does it look like when there's a drastic reduction of the lifetime exemption amount? And what is the lifetime exemption amount?
Well, the lifetime exemption amount, again, is $11.4 million, which means that married couples can transfer $22.8 million free of estate tax. If we greatly reduce that number, and when you do the arithmetic, think about this, and we reduce it to $1 million, I think there's recent statistics that indicate that the average person, if they're at a crisis, 40% of the U.S. population has less than $400 of liquidity to their name. So even if we kept the estate tax exemption at $1 million, the estate tax would never be a widespread mass tax. It would only affect probably less than 10% of the overall population. So that's what I'm referring to when I'm talking about a reduced exemption, one that causes many, many more taxpayers to be subject to the estate tax.
And the significant increase in the estate tax rates, what's the current rate right now, and where do you project that it should be?
Well, the current rate's 40%. I don't have a magic number in my hand about what it should be. I could easily see that it could increase, say, to 45% or 48%, but those taxpayers who are worth, say, in excess of $100 million, that you could easily impose a 70 or 80% tax rate, because even if you were to impose such a significant tax rate, their benefactors would still end up with millions and millions of dollars.
And how do you broaden the estate tax base?
Well, things that mechanisms taxpayers currently use to avoid the estate tax would be brought back in. So, for example, there's special kind of instruments called grantor retained annuity trusts, or GRATs. They go by the acronym GRATs. And there's sophisticated ways that taxpayers use these so-called GRATs to avoid their transfer tax obligations. So broadening the tax base would cause things like grats and other items to be included in the estate tax base where right now they are not.
And finally, what is the generation-skipping transfer tax regime, and how do we strengthen it?
Well, the generation-skipping transfer tax regime causes a tax to be imposed at once at every generational level. So that if you're wealthy, say you're Bill Gates, and your children are wealthy, so you're Bill Gates and you're worth, say, I don't want to exaggerate, I think he's worth $100 billion. And his children are worth, say, $20 billion. Rather than leave money to his children, if that money is going to be subject to estate tax when they die, he might choose to leave money to his grandchildren or great-grandchildren and thereby bypass one generational level of tax. Well, what ends up happening under the so-called GST tax is it imposes a tax at, even if he tries to leave money directly to his grandchildren, it imposes on his estate an estate tax, and then it imposes a separate so-called generation skipping, in addition to the estate tax, a so-called generation skipping transfer tax on monies going to his grandchildren. So it's a tax designed to ensure that monies be taxed at least once every generation. But very wealthy people have been known to leave monies to grandchildren or great-grandchildren and avoid tax on their children's level of income. So there's ways to strengthen the so-called GST tax, the acronym for Generation Skipping Transfer Tax, by reducing its exemption and outlawing what are known as so-called perpetual trust. Perpetual trust allows monies to go from one generation to the next. And again, the way those trusts are prepared to avoid tax at each generational level.
So what are the implications with this proposed estate tax reform on the fiscal solvency of the U.S. government?
Well, in a perfect world, if Congress came around to it and said, what was written here is worth its weight in gold and we're going to institute it tomorrow, is that Congress would broaden the estate tax base, reduce the rates, reduce the exemption, tighten up the generation skipping transfer tax. And as a byproduct of making all those changes, we can anticipate an additional $20, $30, $40 billion annually to the U.S. budget in terms of estate tax revenue. So that might alleviate some of the pressure that's currently placed on labor income to raise revenue. And that's a good thing, because if you alleviate the pressure on labor income, you make it more attractive. So if you reduce the payroll taxes on labor income, you make labor more attractive. And at least for now, automation is extraordinarily attractive because there's no payroll taxes employers have to pay, and obviously comes with its own efficiencies.
And what are the implications for this on wealth inequities within the United States, the huge gap between the rich and the poor?
Well, I think this does a Herculean measure in trying to address that issue, which is besetting the nation. We have currently some of the highest inequality between and among classes people, and there's statistics bandied about where the upper 1% control as much wealth as the lower 90%. And this is hearkening back to the days of the robber barons, where there was great wealth concentration. And by instituting a strengthened or an estate tax that has been enhanced and made more robust, that would, curtail some of the wealth inequality perpetuations that are currently existing.
And what's the impact from this for the recognition of capital gains?
Well, by not causing capital gains rates to go up. In other words, under my proposal, where we have an enhanced estate tax, capital gains rates would remain where they are today, preferential, and therefore it should not cause capital gains to go unrecognized.
And what's the impact of this on capital flight risk?
Well, once again, this whole proposal is a tacit acknowledgement that trying to tax capital more heavily may backfire. So, as pointed out in the paper, when you impose a higher estate tax, it's very hard for the average taxpayer to avoid. Why? Or even not even the average taxpayer, even the supersource taxpayer, because if you want to truly avoid the estate tax, you have to seek to be expatriated. And expatriating yourself from the United States not only is mentally and physically challenging, there's a particular code section, 877A, that levies a outbound tax, so that if you decide that you're going to leave the country and not be subject to the estate tax, not only are you potentially risking seeing families and friends, but you're also going to have to pay an exit tax as you leave.
So, in your opinion, what is the greatest explanation you can give for why this proposal matters?
Well, I think this proposal matters because, at least in my mind, Congress has been wholly fixated on tinkering with the income tax system to resolve issues pertaining to the financial needs of this country. It's been almost blinders on, and just focusing on just how does the country pay for its expenditures, and Congress is again putting way too much emphasis on labor income. This paper makes clear that Congress has the wrong focus. Instead, it should really be focusing instead on the estate tax and using it as a robust resource to alleviate the burdens that would otherwise befall those earning just labor income. So the main takeaway from the paper is, Congress, wake up. You got to look at the estate tax, and you got to strengthen it, not weaken it.
So, as a final question, what should legislators, policymakers, and people take away from your article?
That the future is upon us, and automation is surrounding us, and automation is going to continue to has an upward trajectory. It's going to fundamentally transform the labor market. As it fundamentally transforms the labor market, we're going to reach a point in which we're going to jeopardize the revenues this country really needs, because a large part of the income tax system is predicated on income from labor. That being the case, before it's too late, Congress really has to look at alternative means to raise the requisite revenue. And one of the alternative means that is not easy to circumvent and does not really distort behavior is the imposition of an estate tax. So Congress and politicians or anyone else listening to this podcast, you should really think hard about how you want this nation to raise revenue, what's feasible, what's not, what's going to create deadweight losses, and other attributes that may or may not be welcome. And on a whole, the estate tax seems a lot more attractive than instituting a whole bunch of other taxes.
All right. Well, thank you very much, Professor Solid, for coming on the podcast to talk about your very interesting work.
Well, I really appreciate the opportunity, and I wish everyone well.
used to be that taxes wasn't cause for much concern, for our uncle wasn't worried over the money that we would earn. But today, with rising taxes on most everything you do, sit back and give a listen and I'll try to tell a few. They have taxed your family auto, not to mention gasoline, taxed your weekly payroll and a lot that can't be seen. Your telegrams and phone calls is clothes and carpet tax. You'd think the time would come when revenuers would relax. Taxes, taxes, will you always haunt me? Will I always have to work in vain? You have caused me many tribulations. Taxes, taxes, you have taxed my brain. You win a host of prizes on a jackpot giveaway, and you think that you are lucky, brother, think the other way. When you finish paying them taxes, federal, state, and city too, you wind up paying more in taxes than that jackpot did to you. Taxes, taxes, will you always haunt me? Will I always have to work in vain? You have caused me many tribulations. Taxes, taxes, you have taxed my brain. The scientists are working now. They're trying to figure out just how that they can make us all live forever. Suspended animation for everybody in the nation. I'm asking you, my friend, ain't that clever? We'll never grow to 65. They'll stop us growing at 64, because at 65 you're going to join the pension ring. It's death and taxes, that's for sure, and for taxes there'll never be a cure. So tell me, oh death, where is thy sting? Taxes, taxes, will you always haunt me? Will I always have to work in vain? You have caused me many tribulations. Taxes, taxes, you have taxed my brain.
That was Hank Penny. Taxes, taxes.